the taxman yourself, but you like a company in the tax business, Liberty Tax.
Yes, yes. Liberty Tax is a nice niche provider in the paid preparer space that we like quite a bit.
Isn't that a very seasonal business, though?
It is highly seasonal, and most of their business comes in January and in the April period. Liberty Tax has a franchise model, so they have a lot of independent franchisees who run their own operations, and then they earn fees from the franchisees helping them out with the paid returns.
So we're looking at revenues here, and I guess you can see the seasonality in some of those quarters. Looks like Q3 and Q4 is where you get a better pop in terms of the numbers.
Yes, yeah, absolutely. So there's kind of a surge in January where a lot of the people want their refunds quickly, and they do the quick returns, and then April it starts to get a bit more complicated.
People
and
who want to avoid paying the taxes.
Yes, wait till the last minute,
right.
yes.
Now, this particular company competes against H&R Block, and H&R Block has about a third of the tax preparation business. So when we look at the stocks, Liberty Tax has definitely done better in terms of performance. How is it able to compete against H&R Block since it has that stranglehold?
Yeah, H&R Block is the largest paid tax preparation service out there. Like you said, they have a third of the market. They're in the process of closing offices. They've essentially saturated the country. Liberty Tax has about 4,500 offices. We think they're going to push 10,000 offices in the next 5 years, so they're growing offices. The other thing we like about Liberty Tax, but the whole industry, is that with the Affordable Care Act, there's a lot of people who are going to need help filling out additional forms. And so they're going to need paid preparers to help them fill those forms out, and also it'll give an opportunity like companies like H&R Block and Liberty Tax to charge more because the returns are becoming more complex.
Now, am I right in thinking if they're opening up more stores, but it's a franchise model, their operating expenses would be lower? In other words, they won't have to expend a lot to get those stores open.
Yeah, most of the time the new stores are opened by existing franchisees, so it's just a matter of helping them identify sites, train people, and then start driving the business. So it's a very efficient, low-cost way for Liberty Tax, the franchisor, to generate profits and top-line growth.
And in terms of the bottom line, it looks pretty cheap on an enterprise value EBITDA basis. It's trading higher than its peers on a forward PE. So where do you view its valuation?
Well, right now, Liberty Tax, we believe, is trading at a slight discount to the Russell 2000 at about a little less than 17 times next 12 months earnings. We think they've got much greater growth prospects than the Russell 2000 in general, and also H&R Block. So we think it should be trading at a premium, and we think that if they deliver on the growth that they're talking about, the stock's actually even much cheaper than it looks right now.
Despite that performance we saw earlier in the stock chart.
Yes.
What are the operating margins like for somebody in the tax business?
The operating margins are probably in the high 20% with the franchise model. It throws off a tremendous amount of free cash flow since it is a franchise model and they're not reinvesting a lot in the business. They are reinvesting in online web training and tax forms, but for the most part it throws off a lot of free cash flow. They're repurchasing stock. They just recently repurchased 5% of their stock in the most recent quarter, and so it's a very capital light model that we find very appealing.
What's the biggest challenge or risk that you think about in holding the stock? What would make you sell it?
Well, death and taxes always seem to be there. So
yes.
Yes. So we always know the business is going to be there. Our biggest concern would be if they're not able to find new franchisees who want to open offices, then the growth profile of the company would be reduced, and that would cause us a concern. They generally are having very good success in opening up new franchisees, and so, but that would be the biggest area we'd focus on.